In 2021, Mark Zuckerberg renamed his entire company after a product that did not exist yet. He spent $80 billion building it, and last month, he quietly shut it down. No press conference, no apology, no accountability. Just a product announcement buried in an earnings update on a Tuesday afternoon. Horizon Worlds, the virtual world Zuckerberg bet his company's entire identity on, is gone. The Metaverse is dead, and $80 billion went with it. But here's the question nobody is asking. The same leadership team that burned $80 billion on a product nobody wanted is now spending $135 billion this year on AI. So before you assume this time is different, let me show you exactly what happened. Because the pattern here matters more than the pitch. And understanding that pattern is the most important thing any investor or observer of big tech can do right now. Let's go back to the beginning, because this story does not start with bad technology. It starts with fear. On October 28, 2021, Zuckerberg stood in a virtual space and announced that Facebook, the social network used by 3.5 billion people, was changing its name to Meta Platforms. He declared the metaverse would be the next frontier, a persistent, immersive 3D world where people would work, socialize, shop, and live an entirely new kind of digital life. He predicted it would reach 1 billion people and host hundreds of billions of dollars in digital commerce within a decade. He was so certain about this vision that he renamed the entire company after it. Not a division, the entire company. But here's what he never told the public, and this is the part that changes everything. A 2015 email written by Zuckerberg himself, later obtained and authenticated by researchers at Road to VR, reveals the real motivation behind the metaverse bet. It had nothing to do with building something users wanted. It was about escaping Apple and Google. Zuckerberg wrote directly about Meta's vulnerability on mobile. Apple and Google controlled the operating systems. Facebook lived on their platforms. One policy change, one fee increase from either company could destabilize the entire business overnight. Apple's app tracking transparency update in 2021 had already cost Meta an estimated $10 billion in annual ad revenue by restricting cross-app user tracking. The metaverse was an escape hatch, a new computing platform that Meta would own and control entirely, where Apple's App Store rules and Google's Play Store fees simply did not apply. Meta did not build the metaverse for users. It built the metaverse for itself, and users noticed. The Quest VR headset, the hardware required to access this virtual world, sold only 1.7 million units in the first 3 quarters of 2025, according to market research firm IDC. That was a 16% decline from the year before. Not growth, decline. In a market that was supposed to be exploding into the next great computing platform. Horizon Worlds, the social platform at the center of Zuckerberg's vision, could not generate meaningful engagement. According to CNBC, the platform never attracted more than a few 100,000 monthly active users. By October 2022, just months after its public launch, internal targets of 500,000 monthly active users had been revised down to 280,000. Then, that number was missed too. The platform peaked below 200,000 monthly active users and never recovered. For comparison, Roblox, a platform Horizon Worlds was frequently compared to, was reporting over 65 million daily active users by 2025. A 2024 YouGov survey found that the majority of Americans had not used the metaverse at any point that year. And according to Google Trends data, public interest in the word metaverse peaked in early 2022 and has declined consistently every single month since. The market told Meta clearly and repeatedly that it did not want what was being built. Meta chose not to listen for 4 straight years. Now let's talk about the money, because this is where it becomes genuinely staggering. Reality Labs, the Meta division that housed the entire Metaverse project, has never turned a profit, not in a single quarter, ever. According to Meta's own earnings reports, in 2025 alone, the division lost $19.2 billion on revenues of just $2.2 billion. That is nearly $10 lost for every $1 earned. In Q4 2025 alone, the worst quarter in Reality Labs' history, the division posted an operating loss of $6.02 billion on revenues of just $955 million. And since 2020, Reality Labs has accumulated total cumulative losses of $83.6 billion, according to Meta's own financial filings. To put that in perspective, TechCrunch calculated that you would have to spend $1 million per day for 200 years to spend that much money. You could have purchased Netflix and Spotify combined. You could have funded NASA for 4 full years. You could have written every single Meta employee a personal check for $1 million and still had money remaining. Instead, it went into empty virtual rooms and a headset that fewer people bought every consecutive year. And the internal dysfunction made it worse. A Yahoo Finance investigation, based on interviews with over a dozen former senior Reality Labs workers, found that Meta was systematically pulling experienced managers from profitable divisions like Instagram and placing them in charge of VR teams they had no relevant experience running. Decisions were being made by executives following Zuckerberg's conviction rather than responding to what the data was actually showing. According to that investigation, this created a culture of misaligned priorities that compounded every strategic mistake. Meta's own CTO, Andrew Bosworth, eventually acknowledged publicly that the VR market was expanding at a slower pace than executives had anticipated. Corporate language for, "We were wrong for years, and we knew it." When Meta finally announced the shutdown, something remarkable happened. The stock went up. Investors celebrated. Analysts who had spent years describing Reality Labs as a leaky bucket, a division consuming extraordinary capital with no credible path to profitability, finally got what they had been asking for. According to reporting from Vox, Meta's stock rose approximately 3.5% on the day the Reality Labs budget cuts were announced. The market's verdict on 5 years and $83 billion was delivered instantly and without ambiguity. Now, here is the question you genuinely need to be asking. Meta has committed to spending between $115 and $135 billion on AI infrastructure in 2026 alone, according to its own earnings guidance. That is double the $69.7 billion it spent in 2025. On top of that, Meta has pledged to spend up to $600 billion on AI infrastructure by 2028. To fund this, as we covered in a previous video, Meta is cutting up to 15,000 employees. It is the same pattern, the same leadership, the same decision-making culture that burned $83 billion on an unproven thesis before the market rejected it, now committing capital that dwarfs even the Metaverse investment. The Metaverse was going to be the future. Meta spent 5 years and $83 billion on it, then shut it down without a single profitable quarter. AI is now going to be the future. Meta is spending $135 billion on it this year alone. The people making that second decision are the same people who made the first one, and they are making it at a scale that makes the Metaverse look modest. But here is the detail that should be the headline of this entire story and somehow never makes it. After spending $83 billion specifically to escape the grip of Apple and Google, Meta is still on Apple's App Store, still on Google's Play Store, still subject to the exact policies and fees that triggered the entire Metaverse project in the first place. The Metaverse did not liberate Meta from its dependence on the platforms it feared. It just cost $83 billion to confirm that. So what does this mean for you if you are watching where the biggest bets in technology are being placed right now? It means the pattern matters more than the pitch. A company that commits extraordinary capital to a vision before proving users want it, ignores the market signals telling it the vision is wrong, and pivots to the next big thing once the losses become impossible to defend, deserves hard questions the second time around. The Metaverse failed because Meta built it for itself, not for users. The question worth asking about the $135 billion AI bet is whether anything has actually changed. And so far, nobody at Meta
is being asked to answer it. If this video gave you something to think about, hit the like button and subscribe. It really helps out the channel. We cover AI, big tech, and the stories behind the decisions shaping all of our futures. Thank you for watching.